Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:36 p.m. on a cold winter, well, not winter, autumn evening here on the New York, New Jersey waterfront. It's always colder on the water. 8:36 p.m., October 28, 2018. Almost coming to Halloween next week. This is a weekend strategic update session. These sessions are extremely important for serious traders. And I underline the word serious traders because they lay out the roadmap, as far as we can see, to navigate the intense, extreme volatility that we have been incurring and will be incurring going forward. There's no running away from it. On that note, full disclosure, this is purely for financial education, not for any solicitation or advice. These strategic webinars are recorded, uploaded to the Clueless Trading YouTube channel for viewing by all members, as well as anyone out there with the internet connection. Valuable resource, valuable information. Do spread the word around. It's the least you guys can do. Just mention people to come visit us on Clueless Trading YouTube, as well as follow us for the highlights of some of the stuff that we do on Clueless Trading Instagram channel. We have a nice follower count that's growing, and your cooperation and help is greatly appreciated. Thank you. On that note, let us begin. First screen that we're looking at here, I'm on my, this is the Quad, QUODD platform. These are the algo charts, as I like to call them, which are, in my opinion, the secret sauce to navigate all types of market, but more so now, the importance of trading these particular charts in these extreme volatility, no running away from it, right? We all know it, is critical. And what has kept me grounded and profitable in majority of the cases, including last week, has been the power of tracking and trading the levels. Keyword is levels on these charts, both in stocks as well as the overall indices, the market indices that we trade, the SPX, the SPYs, the Qs, and such, DIA, the Dow Jones Industrial Average, diamonds, and such. Okay. So on that note, a couple of broader points, and I'm going to be flipping through the screens as I'm speaking, so we don't have to look at the same stuff over and over again, is that we are in, and stating the obvious, we are in treacherous times for reasons that we all know. The technical damage on the bigger picture that we have incurred over the past month, believe it or not, it really has been like a month and maybe a little bit less than that, has been intense. No question about it. There has been, I read a number somewhere, which is a staggering number, somewhere at $3 to $4 trillion that has been, or $10 trillion that have been wiped off the global markets, and a couple of $1 trillion, probably, I don't have the exact number, mind you, so don't quote me on it, probably $2 trillion that have been wiped off the US markets. Yet, through all this intense volatility, we have consistently engaged the market, or many of our tactical traders have, and we have made money. And that has to be seriously considered. Why? Because markets are random, but there is a structured randomness. It's almost like an oxymoron. It's random, but it's structured. But that's exactly what it is. And what I try to do here at Clueless Trading on a constant basis, as you know, every single day, whether or not there's a single person or nobody in the chat room, it doesn't really matter, because trading is a solo performance sport. And to me, this is not a sport. This is a living. So I have to be extra serious about it. I have to make money every day, every week, every month. I can't sit back. So bottom line is that it really doesn't matter if there's nobody in the chat room, because that's not really where I'm delivering my content. That's just for basic comments, traders, opinions, bearish, bullish comments and such, going back and forth, and for me to answer pertinent questions that my members have. The real stuff that is delivered, as you all know by now, is on the Twitter real-time feed. And that's really where it all happens. So saying all that, And I know I'm stating the obvious, but I'd like to remind people on that. It's very important that as a trader, whether you're a swing trader, a day trader, a long-term trader, whatever it is, you always have to be engaged with the market. Not necessarily you have to trade every day. Sometimes you can take a couple of days off, but you have to be engaged with the market. You have to know what's going on. You just can't walk away and say, oh yeah, I'll come back to the market 3 months from now and then it's going to be okay. No, it's not going to be okay. Because the minute you disengage, you're lost. You're lost anyway. Most retail emotional traders are. But when you disengage completely, then you're totally lost. So saying all that, we are in, this is the new normal. And we are trading technical patterns, technical charts, technical levels. And honestly speaking, I'm starting to love it. Because I have always been robotic and disciplined in my trading. But now more so than ever, I'm excited. I'm excited because the market is giving me an opportunity, 600-700 points down, 200-300 points up, to execute tactical trades within the specific levels that I show, which most of the times it gets there, up and down. And my time management obviously has increased tremendously. My time commitment, I should say. And it's fine. Because as a trader, I can't wait for the perfect moments. The perfect moments, I've shown you guys what they are. They're on my Twitter feed. Those are the moments which 600-700 points down, and then you get a 300-400 point blast. Happens every single day. Literally every overnight. But do I like volatility? I hate volatility. I think it just screws up so many things. But am I opportunistic and make money off volatility, structured volatility that happens in the market? Yes, I do. And I think anyone can do it because this is not rocket science. The speed and the velocity of this, but the speed of the movements are severe. Nothing I can do about it because that's what the machines are doing. There are $20 billion hedge funds. I mean, $20 billion hedge funds, which are losing money right, left, or center, or just have basically said, you know what, we're just going to sit on the side. I don't know what sitting on the side ever does to them because they're all, I would say, a good 80% of the hedge funds out there, so-called smart money, are losing money right, left, and center. Anyway, I've talked about that before. That's not the purpose of this particular session here on Sunday evening. I want to keep this within a reasonable time. So saying all that, what screen are we looking at? Okay, what we're looking at here are basically the Thinkorswim charts. This is the longer term chart. This is the daily chart. This is where we are. Just going to walk you guys through it. And before I go any further, one extremely important reminder. I did a very, very powerful, to the point, I would say basic to intermediate explanation of how to trade the markets for maximum profits, as I show almost every day using the VIX. What screen is that? It is this screen. Right there. Right there. I highly suggest that all of you review that, even though I posted the same material day after day after day on my real-time Twitter feed. I'm sure it's extra helpful when I walk through the basics of how to use the proxy of my VIX charts, which are extremely accurate. Extremely accurate. There's no question about it. The way I draw the lines, where the pivots are, where the supports are, where the resistances are, extremely accurate. Where the slow stochastics are starting to come down, doesn't matter if there's a big, slight pop and drop in the market by this VIX candle moving up at 2 p.m. I explain all that stuff on the Saturday. I believe I did that Saturday morning. Yeah, Saturday morning. I highly suggest that you guys review it because it's going to put more money in your pocket. It's really as simple as that. And honestly speaking, just between trading the SPY and you can trade the VIX too if you'd like. You can buy the VIX puts and calls, but they don't really pay that much as far as I've seen because, they don't, unless there's a huge move, We have traded that quite often. Sometimes the VIX calls. I've never traded the VIX puts. Yeah, they have paid, but they're not as elastic, or the delta and the gamma and the are not as correlated with the markets the way I would like to move. I would like my options prices to move, whether they be calls or puts, as I get from the QQQs, the SPYs, the SPX, and such. Okay, even the DIA, which I alerted on Friday. So those move literally every 10-point move on the Dow, every point or two move on the S&P 500 or the E-minis. I get a corresponding return on my money on those particular options. They're very elastic. They're very correlated with the market. I don't find the VIX options structure to be as correlated. So it's up to you guys what you guys want to do, but I'm just stating what my experience has been. I've been extremely successful trading the SPYs and the Qs, as you all know, mostly on the long side, sometimes intraday on the short side. They're very fast, they're very quick, and it's been, to me, honestly speaking, it's been a pleasure. So I use the VIX chart, and I highly suggest to study and review that particular video cast, training video, which is absolutely money. It's a money video, okay? No question about it. I'm not a person to really put a lot of flowery language like a lot of the other services do. I'm not Wolf of Wall Street. I'm the lion of my charts. How about that? I'm the lion of tactical charts. So I can't put on too much flowery language. All I'm simply saying in simple English, go frigging watch the video on the VIX correlation and how to trade the SPYs and such on using the VIX as a proxy, because once you get your eyes trained and your brains to recognize the patterns and what I'm putting out there, you will have a very high probability of coming out on the positive end at the end of the day. It's a fact. Or at least you won't panic and sell just because you're getting a VIX spike, but so those stochastics are telling you that it's coming down, and then right after that, as you think you're buying the puts and you're a hero, and some of you have done that, okay, and you get blasted because the VIX just crashes, two massive red bars going into the close at 3 p.m. and 4 p.m. Stochastics were telling you that the VIX is not going to go any higher, and then you look at the other end, and you stayed long, you made money. All right, so please review that. Remember, real estate trading, we're the lions of tactical trading. We're the lions. We're not the wolf of anything. We're the lions. All right. On that note, let me move away from that particular screen and start off by looking at. I got too many screens on this particular basis. That's not it. That's not it. That's the one. Okay. So this is where we are right now. Futures are up 8. Coincidence? We're up 8. Okay. Means nothing. But this is what we're looking at. This is the broader chart. Remember, we are on a macro downtrend. This is 2018. This is where we started. Let me get the cursor in here. Let me get the highlighter in here. This is first day of trading, 2018. Right there. I believe it was the 2nd of January. This is where we are right now. We are on a macro downtrend. If somebody's waiting for that perfect moment where the so-called macro downtrend has stopped, well, I don't know. It could be down here at 2,600. It could be a retest of 2,500. I'm showing all the levels. This session is not about making long-term forecasts, because none of us have any idea, and neither does the multi-trillion-dollar big-time so-called money management complex have any idea. Our esteemed president, Mr. Donald Trump, has no idea. Nobody has an idea. Okay? We are trading short-term to intermediate-term reflex bounces and falls. At this point, we have extreme Extreme. I can't even tell you. I won't even get into it because it's going to take me an hour to show you the 32 or so different indicators that I follow. Next session, maybe I will. Extreme oversold conditions. We're playing reflex bounces. We are selling the pops. And we are buying the panic. All tactical numbers, and that's it. So, saying all that, this is where we are right now. The downtrend is intact. You can see that. The large macro downtrend. However, this is what we are starting to see. We are starting to see a double bottom formation on the daily. This is the E-minis. This is the futures. This is where the action happens. Remember, futures traders have the market by the cojones. All right? By the you-know-what. So when the futures are down, everybody panics. When futures are up, people start to get a little bit happy. And trust me, overall, nobody's happy. This weekend, I was out with my dogs, met a couple of my high-powered neighbors. We all went to this beautiful dog park that was built next to the water, a new one. Everybody's shit scared. These guys are big money guys. They're running companies. One of them is actually a Wall Street guy. No idea about technical or tactical trading in the market. Everybody's scared. Nobody's excited to buy some cheaper prices, trade them, or buy some real cheap prices and make some real money. Look what happened tonight. Red Hat is going to pop huge tomorrow morning because IBM just bought them for a 30% plus premium. How would you like one of your companies to get 30% up while on this massive downtrend in the market? That's Red Hat. All the cloud stocks are going to be up tomorrow. It's going to help the tech sector. I believe it was a 30 to 40% premium. It's a big premium. That's big. That's what corporations do. They look to see and they look to basically capitalize off the massive correction that we have had in multi-sectors, especially in technology. This is the time for them to go shopping. You think IBM's going to be the only one buying stuff? No, there'll be other companies buying up other companies. That's just the nature of the real smart money. The Red Hat news, honestly, was powerful. I saw it pop up late afternoon on my phone. Like, wow. And Red Hat is down 30% for the year. So they paid like a 30% premium. Boom. Take out. All the cloud stocks, I repeat, are going to be up. So, you think Amazon's not going to buy scoop up some other companies? Absolutely they will. Will we be in some of them? I hope so. I know I will. So, saying all that, we are starting to see a double bottom formation. This, on an intermediate term basis, means a multi-day rally. Let's see. We are playing probabilities. We're not playing certainties. There is nothing certain about life. Could wake up tomorrow morning. Might wake up tomorrow morning. Trust me, all right? So, markets, same way. We're playing probabilities. There is a good probability in between the rapid and the vapid, not just rapid, but vapid intraday volatility. The markets are going to climb towards slightly higher levels, which I have pinpointed repeatedly on my structured trading charts, which are delivered on the investing.com site, which I will zoom back on the screen. By now, any of you who are half serious traders should know that. The ones which show exact levels and such. Saying all that, we are also starting to see a minor positive divergence, which is showing up, which is showing up here on the daily charts on the McClellan oscillator. Big money's made of this stuff, and I've showed you guys repeatedly that if you have a little bit of discipline, because when it comes to trading, adults have no discipline. None. It doesn't matter how much money you're trading with. Okay, that's what I've found over the years, since 1996, 1997 period when I first joined Wall Street. Adults, smart adults, have absolutely no discipline. They are like wacky drunk frat kids when they're happy, and they're depressed is whatever. I can't even find an analogy for it when markets are going through these type of systematic tactical corrections. So here we have a positive divergence that I've been showing since the 11th of October. Here we are on the 24th of October. Here we are right now on the 26th, going into the 28th. You know, this was obviously 26th oh, it's real time. So obviously, what am I saying? This is 29th. So you can see the positive divergence building here. You have a higher low, and you have a, and you basically have a, you have a lower low here, right? I've shown this on my charts. I'm repeating this for all your benefit. Right there. We printed, oh, come on. We printed a lower low on the prices while we printed a higher low on the McClellan oscillator, showing that the overall, what it basically means is, like the old saying used to go, the smart money never dumped, just sucking out all the stops, the retail guys, the mom and pops who just never want to touch the stock market again. God bless them. Thanks to all the pundits who are telling us we're going into a depression, that President Trump is going to completely destroy the economy. No, he's not. Do I think he's going to, you know my opinions. I think he's done a phenomenal job. I don't agree with him on certain aspects of the global trade side, but who am I? I'm not, Larry Kudlow and stuff. It's a political game that's played, and that is obviously affecting U.S. companies a lot. It is a fact that a significant amount of U.S. companies, in fact, a majority of them, are not benefiting from this trade tariff war. So if U.S. companies are not benefiting, so who are we trying to benefit by going into a hardcore, prolonged Chinese trade war? I don't know. You guys answer the question in your head, because I'm all about U.S. business. And you know my feelings. U.S. business is what made America great. Nobody else. That's it. U.S. business and intellectual brains. That's what made America great. Nothing else. So bottom line is that going back to technicals, we are, this is a serious positive divergence. Positive divergence on a daily generally take multi-days to play out. And you guys are seeing it. Intraday, you're seeing it. But now you're going to see it on a multi-day basis. Is it going to start off first thing on Monday morning at 9:30? No frigging way. But it is starting. Will we have a dip slightly lower again and retest the 2600 level? Everyone freaks out because we're down another 400. We'll do an intraday short. We'll buy the tactical low while certain members are going to be screaming bloody murder that we're going all the way down. Yeah, good luck. Because none of them have actually made any real money. I know that for a fact. Being dogmatically bearish or extreme bearish at these levels is almost suicidal. That's my opinion. And you guys can see it every single day. You cannot short a market down 600 points on an intraday basis. Got to trade the move higher, and I show it repeatedly. Make 40, 60, 80, 100, 120%. Please review my VIX video. Those are actual facts, actual ROI returns. So that's a positive divergence. We have a double bottom starting to form. Remember, bottoming is a process, not a one-day event. So if you're looking out a month or two, which I have no idea what's going to happen in a month or two, or this process could be a bottoming process. It could start off from lower levels, or it could pretty much start off from around here. It's a process. Massive capitulation. We have a very positive global development in the form of a validation of a capitalist leader of Brazil, Bolsonaro. The world global markets love it. He's not a socialist. He's going to reform many aspects of Brazil, which is a phenomenal country, but bogged down by major labor unions to the point like where we were years and years ago before Reagan cracked them. We're in the business of free market capitalism. Not controlled capitalism, not state capitalism, free market capitalism. That's why I'm so vehemently against when the government intervenes to tell U.S. great companies what to do. You can express your thoughts, but you cannot tell them what to do. Sorry. I'm not a socialist. I'm not a communist. I do not like the state controlling private business. Ayn Rand. Read her. So, bottom line is that this is looking good, and let's see what happens. That's a broader picture. Let's go back into this is your E-minis. This is your NASDAQ. Oh, we're going into a tech depression. Apple's never going to sell any phones. In the meantime, Red Hat is up 30% because IBM just bought them. And here was a company which got slammed. Remember, we played Red Hat earnings in the basket. We got, boom, blown up on that particular trade. Unless somebody put a lot of money in that trade that's really highly stupid. Happened. So we said, fine, done. There were other companies that day which went the other way. And that's the same Red Hat today rewarded all the shareholders. Big time. So saying all that, this is the same story here on the NASDAQ, on the Qs. I still believe from my fundamental analysis, my fundamental understanding of the broader market, and I've been doing this for a while, and believe me, I came from the research, analytical, and sales end. I did not come from the trading end when I worked on Wall Street. Kind of a nerd that way. The tech sector's growth is still some of the highest in all the other sectors. They are still running at 15-20% plus clip. When Amazon falls 100-some points and Google falls 100-some points and bounces 100 points during the day, one of our traders who is here traded the Google call from 4 to 40 on the bounce based off my charts. Congratulations to you. Okay? Their growth rate is phenomenal. They're slowing down a little bit. The market and the algos punish them. Doesn't change the trajectory. They're still the fastest growing sector. Technology in the modern age, I'm not talking the 1800s or 1900s, is what made America great. We are the leaders of modern technology. You guys should know by now. You're watching this webinar. Thanks to great technology, I can run this service single-handedly with a web team just managing the back-end side. So you don't have some peons working for me who are telling you what to do, like many other services. You're hearing it directly from me. Thanks to technology. Think. So, this is where we are. That's your broader channel, entry over the channel. And again, I don't trade the NQ. I trade the QQQs, right? QQQs. You can trade the NDX futures or the options on them. I haven't done that. You guys can do it. So the key is, despite all this stuff, the actual long-term moving average, the 200-day and the trajectory, the slope of ascent of the 150-day and the 200-day moving averages are still climbing higher. Still climbing higher. There's technical damage, no question about it, on the 50 and the 34. What we have now, and similar to the S&P 500, is a massive move away from the 50 and 34 and the 50-day moving average, what we call standard deviation. The standard deviation here is close to -7. On a different measure, they say it's -1 or 2. I believe they're calculating it a different way. I've heard that on Bloomberg and CNBC. This is roughly -7. When you get this type of standard deviation, ladies and gentlemen, I've explained this before. Honestly, you'd be stupid not to swing trade some of these levels, even if they vacillate on an intraday basis. This was the big crashes of 2000 of the early February, after everyone got super excited. And I warned people, this is wave 5. Go listen to my videos. All of you were super excited. Chat room was full. Beautiful. time to short the crap market. I didn't think we were going to drop like this for 1,500 points, but I knew there was a correction coming. And I told people to lighten out. Go listen to my videos. Now, there's not a single peep in the chat room. Everybody's in a state of despair. And you guys are all great people, by the way, guys and girls. All bearish, while we're standard deviation for the moving average is almost -7. Okay, fantastic. Love it. And you all want to short here because you think you're going down here. I doubt it. Can it get down there? Sure it can. But in between, we are trading tactical moves, which can easily be half the drop. So we go from -7 standard deviation to -3. That would generate for you guys almost 600 to 800% on options, on call options. Yeah. And we still remain in a downtrend. Remember, this is the downtrend line. Let me just zoom in a little bit so I can show this. Beginning of 18. Oh, come on, come on, come on. Daily. Okay, so that's, yeah, starting off January. All right, great. So this is where we are. Here's your channel. This is where we are. So I'm going to try to make this real simple here. Here's the highways we normally travel on. We hugged this, we're moving higher. You know, we kept on coming down, testing the 50-34, moving high, and then we broke. And broke hard. Many different reasons. Emerging markets, rate hike fears from Federal Reserve Chairman, his comments, which in my opinion were misconstrued. Doesn't matter. I don't think he's going to go hog wild and raising rates to start with. He's not going to risk raising rates when the global growth and U.S. growth is starting too slow. We had a massive number on Friday. Can somebody tell me what exactly it was in the GDP number, which was hugely positive? I actually did mention that. Can somebody tell me?
3.5.
That's not my question. Listen to my question, Sarm. What was the subsector within the GDP which was extremely positive? Which was extremely positive for the Federal Reserve not to go on a crazy rate hike binge. I wrote it. Anyone remember? Well, I don't have all night for you guys to remember. We had the PCE deflator that the night before I'd mentioned was going to be the most important component that the real smart money watches. And we are smart money at Clueless A Trading. At least I try to be as smart as possible. The PCE deflator is a measure of inflationary pressures within the gross domestic product. The PCE deflator was lower than expected. I believe it was 1.9% versus 2.3. In simple English, if I was sitting across from me having a glass of wine or I don't do martinis, you know, a single malt scotch, it simply means the Fed is not going to go hog wild because inflationary pressures within the strong U.S. growth in the 3+% range was softer, which is great. We got strong growth with slightly lower inflationary pressure for obvious reasons. Oil is down, from the peak. Wage pressures are moderating. But oil primarily is a big component of the inflationary pressures. Housing prices are starting to come down because things were going hog wild. So if the inflationary component, known as the PCE deflator within the GDP, okay, which was strong. Look, the average guy out there who is not with Clueless A Trading looks at the headline numbers and says, whoa, we're growing at 3.5%. Things are going really crazy. The Fed's going to go raise rate. No. Because behind that was the real number that I told people to watch for the night before. I believe I did a video cast on Thursday. Yes, I did. So the PCE deflator, tough for me to write this, okay? Deflator, like a tire pressure, was actually softer. The PCE deflator was lower than expected. I believe they were expecting 2.3%. This is the inflationary numbers. What's all this big fiasco about? That inflation's going to go hog wild, rates are going to go nuts. In the meantime, I also posted that the 10-year government bond inflation number. Okay? So that means inflationary pressures, they actually came at like 1.9%, something below 2, which is extremely positive. I trade with my brains, guys, okay? My charts and my brains. And I hope a lot of you know. That's all I try to teach. That's all I try to teach. Okay? So that was great. Doesn't matter what the intraday fluctuations are. Doesn't matter the sell programs having to satisfy forced margin sellouts, blah, 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 which are facts. There was a global margin call. Big time. You think it just dies down in one day? No. That's the reason every pop was sold. And it probably will be for the near-term future till we see most of the global margin calls, which are in the trillions of dollars, satisfied, i.e. sold. The books equalized on the debit and credit side on the margin clerks thing. In the old days, they had a big book said, okay, this guy owes $10,000 on his margin call. I got to cover the $10,000. If he doesn't send me the money, I'm selling it. That's the way it works. Now it's automated. That's why we're incurring so much volatility, plus the strong dollar. So inflation figures were softer. Bear with me one second. Thank you. And known as the PCE deflator, right there. That means the Fed, overall, not just with one figure, cannot justify saying, oh, inflation is really going nuts, when the actual inflation component of the U.S. gross domestic product, which has been boosted by the very favorable business policies, that the Trump administration has initiated, is going to moderate going forward. There might not be a December rate hike. And even if it's a December rate hike, the Fed might very well say, you know what? I think we're okay with keeping rates at this level. The smart money knows that. And I'm telling you this now. Okay, let's move on. So focus on the things that I write. Don't get into a level of despair that you don't even read my tweets. I'm talking about everyone here. Wake up, guys. I'm pumped up. Okay? And some of my traders are pretty pumped up, because they're trading tactical. You want to trade emotional? Wait for some beautiful moment where the markets are just going to go up for weeks and weeks and weeks? Well, no. Wake up, guys. This ain't grandpa's market. So again, on the NQs, we're seeing the same story here. A positive divergence, a double bottom. So far, we could slip and slide. Apple could miss numbers. But once it enters this channel, overall, all I know is that the mean reversion, that's what I started this conversation with, is so far, all I know is that we could easily at least test the 200-day moving average, the white line here, or test the yellow line here, which is around 7,200, which basically means the techs are going to have a sharp bounce. Will it go back and retest the back end of the 50 and the 34? Sure. It's done that before many times. Is it the same type of pattern symmetry as this? Pretty much. But there's been major severe technical damage done over a short time. This reminds me more of this, what happened in February. And no retail emotional trader, or retail trader for that matter, including most of you were in the game. Some of you were, because we were trading, and we had bang, 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 multi-week, multi-day rallies that we captured good portions of it along the way. Can we have that again? Absolutely. Absolutely. All right, let's move on. So this is that's the end.